Hello to everyone listening to our podcast, The Active Investor with SGH. I'm Steve Hiscock, the chair of the company, and it is my pleasure to be your host for today's episode. In today's podcast, we'll be looking at what happened overnight with the tariff announcements, and then we'll look back at what's happened over March 2025 and what these both mean for the outlook going forward. This podcast is being recorded on Thursday, the 3rd of April 2025. And joining me again today is our Chief Investment Officer, Rob Hogg. Hi Rob, welcome back again.
Thanks very much, Steve. Great to be back on this very, very quiet day.
Yes, very quiet indeed. Yes, the market is down
About 1%.
about 1%. Yes, exactly.
In early afternoon.
Yeah. So, look, it has been an incredible month, a really interesting month. And the markets, to a large extent, the markets have focused pretty much on what's going to happen with the tariffs. And these announcements were made overnight. So, look, given the importance the markets are placed on this, why don't we start looking at the announcements regarding the tariffs? And if you could start by, Rob, just giving us a brief summary of your thoughts, a helicopter view. Is it as bad as feared? Is it not as bad as feared? Is it worse? It's interesting, as you mentioned, the market. The market fall would sort of imply that it's worse than expected. What are your thoughts on that?
Yeah, no, you're absolutely right. When you do get a market falling in price, that is usually because stuff is worse than expected. And look, initially, so the announcements were made earlier this morning, our time, around the close in the United States of their equity market. So that's about 7 a.m. on the East Coast. And the initial reaction was very, very negative indeed. So looking at US markets in after hour trade, they were down by 3.5% to 4% or thereabouts. Right. They've now pared back about a percentage point of that, maybe fractionally more. And similarly, when our equity market opened earlier this morning, I think it was down almost 2% at one stage. Now, as we're recording this in the very early afternoon, the Aussie equity market is down about 1% only. So initial reaction, markets look at far more negatively, but as we've gone through the trading day, some of that negativity, not all of it, has dissipated. And in fact, one of the biggest impacts we've actually seen is in terms of interest rates here in Australia, where there's been a not insignificant move in interest rates all the way across the yield curve here in Australia today, down around 0.15%, which is a reasonably sizable move on a daily basis. The Aussie dollar, look, it is a fraction weaker, but it's only about half a cent or thereabouts. And as I was saying earlier, with equities, the initial reaction was more negative than it is now. It's still negative, but it's just nowhere near as negative as it was when the announcement was first made.
Well, it'll be interesting to see. Look, I'm going to ask you just to give you some warning about the Reserve Bank and potential interest rate cuts, but it's interesting that the market is down 15 basis points across the curve. That does imply that maybe the RBA will cut, but we'll get on to that. Okay, I'm going to tell you a statement that he made. Can you please give me your reaction to it? So, sorry, when I say he, I mean Trump. Trump said these tariffs will remain in effect until such a time as is determined that the threat posed by the trade deficit and underlying non-reciprocal treatment is satisfied, resolved, or mitigated. In the way you read that, a somewhat complicated sentence, are you reading that might mean that some of these tariffs might be wound back?
Yeah, no, look, absolutely. I think all of these things are up for negotiation through time, depending on what other countries around the world do. Look, I thought I might actually just very briefly just speak directly from the statement that he made. So, first of all, it's interesting, I guess, to note that he's used powers vested in him as president, including the International Emergency Economic Powers Act and the National Emergencies Act. So that's interesting the way he's couched the announcements today. He then goes on to talk really about the rationale. So he says, I, Donald J. Trump, President of the United States of America, find that underlying conditions, including a lack of reciprocity in our bilateral trade relationships, disparate tariff rates and non-tariff barriers, and US trading partners' economic policies that suppress domestic wages and consumption, as indicated by large and persistent annual US good trade deficits. These constitute an unusual and extraordinary threat to the national security and economy of the United States. Apologies about that very long sentence, but that is literally what he said. So it's interesting just to sort of get that sense of where he is coming from. So it's all about what the White House presumably regards as unfair trade practices. And I think, to be fair to them, there would be quite a number of cases around the world where there are unfair trading practices. But that is the corner, if you like, from which Trump and the White House are speaking today.
So that's their starting point, if you like. And so the word reciprocity, that was used a lot in his televised address and is all over the internet in terms of describing how he describes the other countries' tariffs. But if we took Australia, for example, it's not actually strictly correct that it's a reciprocity against an Australian-based tariff, is it? Because we don't charge 10% tariffs on US goods. So what does he mean really by reciprocity in that case?
Well, look, I think, yes, well, we're unique. Every country is unique, obviously. But I think what he means by reciprocity is whether or not the US runs a trade balance or trade surplus or a trade deficit. Now, in fact, with Australia, the US runs a trade surplus. So you'd think that we'd be, as far as plenty of other countries are concerned, we'd be toward the better end from the US point of view just because of that. But I think reciprocity more broadly means the nature of the way goods and services are treated as they come in and out of countries and just exactly what the barriers might be. So we're not just talking necessarily here about tariff barriers, so charges, customs duties and so on and so forth.
And GST
and GST.
Yeah.
We're also talking about things like biosecurity laws, and I know that's been highlighted with Australia, that quite naturally as an island we have very stringent biosecurity laws, and some countries might regard that as being deliberately designed to be a restraint on trade. So that's one example. But I think broadly speaking, reciprocity suggests that he's looking for trade balances with the rest of the world, and certainly not trade deficits with the rest of the world. But we know that that's quite difficult, indeed impossible to achieve in large part when you run a huge current account deficit, as they do in the United States, and where we've got these very, very significant global supply chains and so on. So it just runs counter to just the common and modern way of how global trading nations work together.
And also, there are some exemptions globally, aren't there, Rob? I mean, for example, steel, aluminium and automobiles, they're already subject to tariffs, so they will not be subject to additional tariffs as far as I understand. And it's the same with things like copper, pharmaceuticals, for example. They're also expected to be hit with additional tariffs. So they're not likely to be hit with additional tariffs. And obviously there's some that where they've got shortages, for example, energy, that's not necessarily widely as available in the US, and they're not necessarily going to get hit either. So there are some exemptions. Can we talk about Australia a tiny bit? So in Australia's case, it looks like it, you know, the actual amount our exports is really under 10%. So it's not actually going to be that significant as a first order effect. I mean, first of all, do you think that's right? I mean, am I simplifying it by saying first order effect and there'll be other order effects, or?
Well, I think you are sensibly simplifying it like that, because who's to really guess what the second round effects could and possibly might be. But yeah, look, in Australia's case, he has spoken about putting on a 10% tariff applying to Aussie and New Zealand goods. But really, Aussie goods exports to the US are not a huge amount of GDP, indeed around 1%, I've seen reported in some reports earlier today. So we're not talking about something that will be hugely economy moving. It could obviously have impacts on individual industries, but on the overall Australian economy, the imposition of this 10% tariff on Australian exports is not really going to have a huge effect. Much more important, of course, will be via the impact on our major trading partners, so China in particular. That's where, if we're going to see any effect, and we very likely will, that's where we're most likely to see it come through, not on the impact on Australian exports, I don't think.
Well, if we talk about major trading partners, let's look at China. So correct me if I'm wrong, but the way I read the release, there's already a 20% tariff and they get another 34% tariff. So the tariff is 54%.
It's like that on the face of it, yeah.
I mean, that's really quite punitive.
It is, and you would think that that would have big implications for Australia. Now, a lot depends obviously on what the Chinese do in reaction to that. A lot depends upon whether and how much of this is all just the usual Trump bargaining sort of pattern, where he comes out often with very big numbers, very wide numbers, and then uses that as a negotiating point. Although I think the fact that most everybody seems to have cottoned on to that must, in the fullness of time, make that sort of bargaining approach less effective. But on the face of it, yes, that's what seems to be the case. China does look very significantly impacted on the face of it on what we've seen this morning. But this is obviously only the very, very opening of what will very likely be a very long and protracted process. And of course, we haven't even spoken about what the Chinese might do domestically to try and boost their economy as well. We'll come back to that a little bit later.
Yeah, absolutely. And look, the other thing is retaliation, right? So Australia has come out this morning and said that they're not going to take any action on the basis of this tariff, but certainly other countries are going to be almost forced to, aren't they? If you had to guess, and it is a guess, I mean, what do you think? China's now looking at a really punitive tariff regime for its exports to the US. I mean, what are their options?
Well, it's a little bit difficult to suddenly move all of their manufacturing activity to the US, which is ultimately what Trump is about, trying to reshore or onshore various manufacturing industries. And that, of course, wouldn't make any sense for a lot of the stuff that the Chinese make. So I can only guess that it'll be bargain from here. And, of course, there are huge geostrategic issues rolled up in all of this as well, which I don't think can be divorced from the trade policy that we're looking at today.
No, and it's the old, I don't know if you remember reading The Butterfly Effect from, was it 20 or 30 or 40 years ago? You know, the fact that a butterfly's wings flap somewhere in Mexico and it ends up being a hailstorm somewhere else. And you do wonder about the unintended consequences here, because everyone understands what he's trying to achieve. The problem is that there are going to be casualties that they haven't really thought of yet. And that's, I guess, what worries investors too, right?
Exactly. Although bizarrely enough, well, not bizarrely enough, but just the very fact that we've had the announcement this morning, in a sense, is fractionally less uncertainty.
Yes.
Although it's only just really kicked off another plane of uncertainty. But the fact that we've got through the night overnight, and yes, markets were pretty weak earlier on, but have recovered somewhat. I don't think Liberation Day in the grand range of how it could have turned out. It could have been considerably worse, but the uncertainty has been fractionally lessened, and that is something that markets just very, very quickly price in and come to cope with.
And it's fractionally less worse than expected. It's certainly Canada and Mexico must be feeling that, because they already faced 25% tariffs, which is, he's been tied to the drug trafficking, illegal migration and so forth. They're remaining in place, but they're not going to be subject to new additional tariffs. Is that right? Does that lessen the risk of retaliation?
Well, certainly from there, but you mentioned China with this extra 54%, Taiwan an extra 32%, India 26%, Korea 25%, Japan 24%. So that's really where most of the upside surprise, the negative surprises come, I think, from the overnight announcement.
Okay, so there are marginal winners, as in they didn't get punished more, but there's some real losers out there.
Yep, on the face of it, yes.
So, I mean, some of these are really strong allies. I mean, it's an incredible thing to do, isn't it, really, from that perspective? If you look at Japan, they've been an ally for a long period of time, and yet they've been slapped with a massive tariff.
But this is sort of the whole Trump new world, where everything's being redrawn and becoming more transactional.
And of course, Rob, all this has to be essentially ratified, doesn't it, by the legislature?
Yeah, it has to be ultimately, and there, of course, even though, of course, the Republicans took the White House and both houses of the Congress, the numbers there are relatively thin. The majorities there are relatively thin. So really nothing is absolutely for certain. And at the very least, some of this mooted legislation could be bogged down in the various workings of the Congress and perhaps even changed to a small extent or a large extent, or perhaps even turned on its head. So there's all of that uncertainty as well about the whole legislative process.
Just so that listeners are aware, we're speaking about 5 hours after the announcement, so there's going to be so much happening after this, including that all these things that ultimately have to get passed. One thing that worries me a little bit is the inflationary consequences of what he's doing. So he spoke a lot this morning about, company A is spending 500 billion, company B is also spending 500 billion, company C is also spending 500 billion, remarkably symmetrical numbers. Then he ran off a whole list of companies that are spending billions. So, okay, let's say these numbers are wildly inflated or somewhat inflated. They're still going to spend some money, and in a capacity-constrained economy, it's got to be inflationary, doesn't it? I mean, what happens?
Well, you would certainly imagine it would, all things being equal, it would lead to at least less downward pressure on interest rates. For the Fed, that kind of investment response would, you imagine, be viewed as being growth positive, and as a consequence would leave the Fed in the position where there was likely less need to cut rates. That's not altogether a bad thing, obviously. But they need that, and they need inflation pressures to ease, to really move further ahead with rate cuts.
Yeah, well, it'll be interesting to see what happens there. I mean, all this spending that Mr. Trump has announced on behalf of these corporates, which was very kind of him, but at the moment, obviously, there's a heightened risk that the US is moving into recession, and it's not a done deal, but certainly the probability has increased. What does this announcement do to that scenario?
Well, look, in some ways, it takes away some of the uncertainty about what he was going to say. Yeah. But I think he only layers on top of that just incredible uncertainty about how other countries will react, what US corporates should do. And it's just the volatility of the narrative, and then the announcements, and then the potential peelbacks and the deals. All of that is really starting to impact sentiment in the United States, and we can see that for corporates, we can see that for households. It is raising inflation fears and concerns. And we can see that as well in the bond market over the shorter term, out to 2 years. There's definitely a higher inflation rate discounted over that time period. So it is starting to have an impact on sentiment and expectations. And of course, the concern is that if these trends continue, the uncertainty, inflation fears, that it becomes self-fulfilling. Yeah. And that you do get companies that put off investment decisions or employment decisions, and households that similarly put off decisions because of the uncertainty and the concerns. And on the inflation side, you have the risk that these much higher inflation expectations over the short term become part of people's daily thinking. Yeah. And that is when inflation can really take off, when the view becomes that inflation will be higher. Well, that often leads to inflation being higher. Yeah. So those expectations are very important to try and control those inflation expectations.
Yeah, and you talk about uncertainty. With all this uncertainty, there is no way that these corporates are going to spend all this money on a policy that may be reversed in 4 years. It's just not an economically rational thing to do. So there's no way all this CapEx is going to happen.
No. And look, one of the things we've been looking at is, are the trends in CapEx intentions. And so far, they haven't fallen away. No. So far, they remain somewhat solid, if I can put it that way. A little bit like the same story with employment too. So far, we haven't seen significant increase in layoffs, either by the government sector or by the private sector. But as we were just saying, that can change if the uncertainty lasts long enough and remains at a high enough level. There is a correlation between the two if the relationship lasts for long enough, time-wise.
So, Rob, you used to be an economist many moons ago, but like these surveys, that clearly they haven't asked the people that are going to spend $500 billion, apparently. Otherwise, the CapEx intentions would be through the roof, wouldn't they? So are these surveys, I mean, how are they actually chosen? They haven't spoken to Microsoft and they haven't spoken to all these NVIDIAs and so forth, if these CapEx surveys are correct.
Well, they likely have spoken to a number of tech companies, and they would talk, and they do, because you can see the survey responses on an industry by industry basis. So in the ISM survey, the manufacturing survey, which was released just a couple of nights ago, you can go through the commentary on an industry by industry basis, and uncertainty, trade, inflation concerns, inventory building ahead of potential tariff concerns, all of these factors are common across the feedback. You can see the building there of inventory levels, and which is really bound up with the concerns and the uncertainty about what the outlook looks like.
Well, that's right. Uncertainty is the word of the day. Look, I was going to ask you if we're going to see a trade war, but the problem is that we just don't know at this stage. It's way too early, and I get that you'd have to be very cautious in your response there. It's very early days, obviously. We've only been a few hours into this new era. We'll obviously know a lot more when we catch up next month. Moving on to other things, tariffs have obviously been the focus, but they're by no means the only thing that's going on. Can we talk very briefly about what's happened over March? Equities continued to weaken, didn't they?
Yeah, they did. And without going back on this uncertainty yet again, that was a significant part of it. But interesting that the most weakness was observed in the United States. Yeah. So all of the key US market indices were down by way more than was the case in most other countries, certainly continental Europe. Although continental European markets ended the month a little bit weaker in general as well. But look, we've spoken a few times about this whole US exceptionalism thing. This sentiment is incredibly positive sentiments towards the United States at the end of last calendar year. And that just built on the Trump re-election and all of the talk about tax cuts and deregulation and so on. And that euphoria really pretty much peaked at the end of last year. So positive euphoria for the United States. We've also spoken before about how, in a sense, the flip side of all of that was growth fears, tariff fears for continental Europe and Asia, but China in particular. And as we've sort of been suggesting, when you get such polarised and almost extreme views, it really doesn't take a lot to turn things back the other way. So I think part of what we're seeing is just a reaction to what were overhyped views about the US, and similarly a reaction, but in the opposite direction, to what were overly pessimistic views on continental Europe and China. And what's really, in a sense, turbocharged that, in the US, the negativity, if you like, has been turbocharged by this uncertainty and the effect it's having on sentiment, corporate sentiment, household sentiment. But also very interesting and important to point out that in Germany, they announced and then passed during March the biggest fiscal spending package that they've had since reunification of East and West Germany. Well, they sold off quite a deal over the month and ended up by a little bit more than 30 basis points higher. And that dragged up other continental European bond yields as well. But in a sense, that's a positive, because what we really see in that was the discounting by the market of stronger expected growth, particularly what we describe as a fiscal impulse. So that's the impact on the economy of budget spending, and that's projected by some analysts to move from being a drag on growth to being a boost to growth. Not so much necessarily this year, but moving into 2026. So for all, that's all of the best reasons to have an increase in bond yields that we saw in Germany and across continental Europe. And then the story in China is similar in some ways, but not because of a huge fiscal turnaround, but because very, very negative sentiment. And yet we've seen for the last couple of months some slightly better, indeed slightly positive outcomes there in some of their industry surveys. So again, it all goes back to where we started. It all goes back to where the market was positioned. It all goes back to the extreme differences in sentiment and how they're now, if you like, coming somewhat closer together. And part of that is what we see in the equity market performances, not only in the month, but also calendar year to date.
Yeah, well, that's right. The European markets have been much stronger, haven't they? They're probably the best performing markets this year.
Particularly the German market, the DAX, one of the very best performing indices in the world. And those markets are still up 5 to 10% year to date. whereas US markets are still down around 5% or thereabouts.
Right.
Or more.
And look, with your economist hat on, so the Germany decides to spend X billions of dollars on defence, and that feeds its way through to the rest of Europe and the rest of the Germany obviously initially, but obviously the European economy, right? Can you run through how that would work?
Well, and that's what we see reflected with the bonds. That would filter down those defence-related orders. But it's also infrastructure spending as well. They're two parts of the same package of vaguely similar proportions. There's a broader impact on European manufacturers of capital goods and defence-related goods and so on. It is a very, very powerful impetus. And look, in a way, this would very likely not have happened without President Trump.
Yeah.
So you talk about unintended consequences and butterflies in Mexico. Well,
this could be a moth.
Yes,
But
that's
look,
right.
that's okay. So it's been decades that the European economy has been trailing US GDP, right? It's been, I don't know what it is. I'm going to guess at roughly 1% per annum, but it's probably not.
Probably more.
Right, probably more. Is this the thing that changes that?
Look, it will in the short term, but these differentials, growth differentials, come back to a lot of factors, including culture, but population, productivity, longer term economic growth. And compared with continental Europe, the US really runs rings around continental Europe on really all of those variables. But the productivity growth, innovation, investment, population and participation rate might be the one area where they're somewhat closer. So just the nature of US culture will always be one that challenges the past and regenerates. There's every incentive to invest. Europe is a very, very different society.
Yeah.
I mean, you have an unemployment rate of a much higher level in Europe. I suspect partly because that's what society wants and is happy to maintain. Whereas you get the sense Europeans would never be happy with the type of wage rates and conditions that the US imposes across the broader private sector, which means they have a much lower unemployment rate. I think, thankfully, Australia's somewhere in the middle.
Yeah,
I think
thank
we've got
God.
a much better balance of policy and social structure.
You mentioned China before, just some of the indicators that you're seeing. I mean, are they soft indicators? Are they sentiment indicators, or are they actual hard data coming through?
No, good point. They do verge on the soft side. They have, however, been going up for a couple of months, interestingly in the face, clearly, of volatility and uncertainty globally.
So we could end up with a situation possibly where the economy physically starts to recover. It's been in the doldrums for a little bit now, and obviously that's had a huge impact on the equity market. But do you think are you seeing the signs that this is going to turn?
It does seem to be that way inclined. And again, unintended consequences, or not so much unintended, but one of the byproducts of the announcements overnight could possibly be a bigger than expected fiscal or spending package or monetary related policy package in China to address what the US has announced overnight. So it's important, I suppose, to think about all of these events as occurring where there's all kinds of reactions and policy announcements that others will make, and it's almost impossible to make a judgment any particular day on exactly how it will pan out.
Yeah, exactly. All right, well, let's have a look at Australia. The inflation seems to be drifting in the right direction, gently downward. It's giving the RBA, the Reserve Bank, scope to cut rates, but it didn't cut in April. I know it wasn't widely expected, but what did you think about the decision not to cut rates in April?
Well, look, as you say, it really wasn't expected. It was interesting, as it always is, to read the Reserve Bank's accompanying statement, and also very, very interesting to watch the press conference that the Governor of the RBA does. So that's been a fantastic change by the RBA in the last little while under the new Governor, Michelle Bullock. And the tone was really quite different in that meeting, and the tone was quite different in the statement, in the sense that when they cut rates in Feb, the bank and then the Governor spent a lot of time pushing back against market pricing, which was at the time, for probably what it is now, about 3 rate cuts. So the pushback was that the market is just getting a little bit away with itself, and that the Reserve Bank at the time was nowhere near as convinced as the market that all of these rate cuts would be forthcoming. Now, it's not that the governor or the statement came out and endorsed market pricing, but it was a lot more balanced about market pricing. So that, on the face of it, suggests that the RBA is a little more inclined to think about cutting rates now than they were thinking about cutting rates again after their Feb cut.
And
The CPI
surely the unemployment figures that came out, the employment figures, that came out that surprised on the downside, I think you mentioned in a recent article, surely the Reserve Bank will have to take that into account.
Yeah, they will. And the CPI, as you mentioned before, it is drifting ever so slowly in the right direction. The employment numbers were indeed a big surprise, down by almost 53,000 in Feb, but I think, to be fair, they've surprised us on the upside for many months.
Yeah, good point.
So look, in all of these numbers, it's probably best to look at the unemployment rate. It is less affected than the other numbers by just the month-to-month quirks and features of the numbers. And it, as you said, remained unchanged at 4.1%, which is not that far away from where it's been for quite some time, and not that far above its recent lows a year or so ago. So on the face of it, that still points to a pretty supportive labour market.
Okay, well, there's lots of people out there that are hoping for 3 rate cuts this year. So, let's talk about the political side and the budget. So the budget was handed down in about a week ago, March the 25th. Can you give us just a brief overview of anything that particularly struck you? I mean, given the election has been announced for the 3rd of May, clearly there was a framing towards return to power, which is not surprising, but was there anything that did surprise you?
Well, look, I think probably that the tax cut announcement was the main surprise. But having said that, the days of budgets having a big impact on either the equity market or the currency or interest rates or interest rate expectations, they seem so far in the past that it's hard to remember. And this, in a sense, was pretty similar to that. Broadly speaking, there was little in the way of reaction in these broader market indicators to the budget. There was broadly very little reaction to the election itself. The announcement of the election. More important, as is very widely discussed, is the nature of the next government, whether it's a minority government or a majority government. And the difference obviously being that with a minority government there's less policy certainty. So that will be the next key hurdle, if you like, for the equity market to get over.
So what you're saying, from an equity market perspective, a clear majority by Labor or Liberal would probably be okay, but a minority government might lead to a market uncertainty, I guess.
Yes, exactly that. And we know that there's nothing markets find more uncomfortable, like all human beings, than uncertainty. And that's what you're more likely to get with a minority government.
So that leads me on to the final question, really, which is, I mean, what do you think about equity markets from here? They've come back a bit from admittedly all-time highs. So everyone has been observing how expensive they are. In the US, I guess it's the super expensive end that's come off more than the cheaper end. But I mean, where to from here in terms of broad equity markets? What's your view?
Well, look, equity markets globally are still well weighted toward the more expensive side of their longer term sort of ranges, if you like. Uncertainty is still, and is even higher. So look, we spoke last month about being more cautious. We moved from cautious optimism, which is a position we've held for the last several months, to becoming more cautious. We remain more cautious, although we do note, of course, the fact that markets have given up a deal, more so the US markets, from their peaks. So clearly some of this uncertainty and downside is being priced, but it's still an incredibly difficult environment to make any sort of forecasts about how things will pan out. Hence, we just redouble our efforts looking at any and every potentially useful piece of data, and very reasonably clearly, pretty clearly on that basis, sentiment has clearly rolled over and fallen quite sharply, but actual indicators of spending still remain relatively solid. So the key here is how long the uncertainty is maintained and at what level, how heightened that uncertainty is. Uncertainty at a high level can become self-fulfilling, and we honestly don't know what Trump will say tonight, tomorrow, the next day, and I don't think anybody else does. We remain cautious, although we would note that markets are fractionally cheaper than they were a month ago, and that some of this uncertainty is now being discounted in prices. So, but really for equities to move sustainably higher from here, you need continued downward inflation trends globally, more rate cuts globally, whilst at the same time underlying economic activity and earnings remain reasonably solid. So it would be extremely helpful for all market participants to see all of this tariff talk settle down somewhat, and then we can all get used to perhaps a new normal, which in all likelihood won't be as positive as the old world. But if we can get some certainty, that will be at least a small positive.
Yeah, but then, as you say, maybe it is a positive world for maybe China. They're forced to spend money internally. Maybe Europe with this defence spending and infrastructure spending, maybe they end up being in better shape. And as you said before, it wouldn't have happened necessarily if it wasn't for the actions of the US. So, Rob, thank you again.
No, pleasure, Steve, as always. Thank you.
Done a great job distilling it in confusing information into clear, concise statements. As we discussed last month, and you mentioned it before, a cautious tone is definitely appropriate at this time. We're definitely in for a bumpy road. It looks like it's set to continue. Volatility is something that we've got to expect because at the moment we're announcement driven. And so we're hanging on the next announcement, as you mentioned before, what the US says tonight and next night and so forth. But hopefully we can get these concerns to settle down a bit and the market will appreciate that. So thank you, Rob. And that brings us to the end of today's podcast. We looked at what happened with regards to the anticipated tariff announcements, the much anticipated tariff announcements, and then at what happened across the globe in March in the run up to this. And then we looked at what it means for investors going forward. We hope you enjoyed today's episode. Please subscribe so you don't miss out on future podcasts, and follow us on LinkedIn, YouTube, Spotify, Apple, or wherever you get your podcast from. And please do let us know if you have any questions or comments. Until next time, stay informed and stay active. This podcast is produced by SG Hiscock and Company. It does not constitute financial advice and assumes a certain level of knowledge. It is general information only and does not take into account the investment objectives, financial situation or needs of any person and should not be considered a recommendation.